All right. Today is Monday, the 23rd of January, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight, and it's going to be a late night special, baby. And I know if you happen to be in the East Coast, you're saying, hey, Maverick, every single day, it's a late night show for us. I got you, I know. But once we're done with the shitstorm, that's what it really is, you'll get it earlier, okay? But you East Coasters, you're tough. You're not like these crybabies in the West. Anyhow, now that we started an East Coast versus a West Coast fight, forget about Tupac and Biggie. We're starting a fresh one now. But anyways, I'm going to keep you companied here in my late night special. I'm going to keep you entertained. I'm going to keep you informed. Forget about Colbert. Forget about Fallon. All of these dull clowns. I got your back. Now, with that being said, what's going on in the market today? Oh, an insane rally. Higher we go. The bear market is over. It's done. Soft landing. Fed is going to back off. And everybody's going to live happily ever after. Oh, what was that? You're not buying it? You're not trusting the rally? You're afraid of the hawk? Jerome Powell? Forget about Jerome Powell. He got the thing now. The guy might not even make it. Just put your blindfolds on and chase this rally. Come on. But look, while some folks were chasing the rally, and again, the majority of humans were not participating today, this was once again an algorithmic/mechanical rally because it depends on the call options, gamma squeezes, etc., etc. And the evidence, of course, is in the volume. And therefore, in days like we got today, you got two choices. You can chase the rally, you can buy calls, intraday, flip them for profit, in, out, hello, goodbye. What you don't want to do is fall into the trap and go ahead and believe this rally and go all in, buying new positions, bidding big time on call options. This is going to continue for days, if not weeks and months from now, because the bear market is over. And then, of course, the rug gets pulled. The other choice you got is, you know what? I'm not chasing it. The premiums are too high. The move is happening impulsively. We have a lot of traps coming. Number one is the core PCE coming out on Friday, I believe. And of course, the most important one is the FOMC. You don't want to fight the Fed too much. You don't want to piss off Powell before the meeting, because if we rally too high, he's going to come out and he has no other choice but to put an end to it. And therefore, the other choice that you got in days like this is to play the counter trend. And therefore, today I was active in Discord, and right after the open, I said, look, I have a put list here that I'm watching. It includes names such as Amazon, Las Vegas Sands, Nvidia, Meta, Google, and I'm also looking to buy some calls in LMT right before earnings. And of course, as the action progresses throughout the day, new names will be added to the list. But I'm watching now. I'm watching the action, I'm watching the charts, I'm watching the options market and what's going on, who's buying calls, who's buying puts, which one has the upper hand, what are the strikes they're betting on, etc., etc. But I also reminded the viewers with a timeless piece of wisdom. And it comes from William Peter Hamilton. This is the classic, the stock market barometer. And in a day where we have an impulsive rally based on low volume, this kind of hits close to home. And it reads, one of the platitudes most consistently quoted in Wall Street is to the effect that one should never sell a dull market short. Meaning you got a market rallying higher with low volume in a bull market, keeping trend. You really don't want to fight it because you're going to be alone. There is no support for you to push these charts down. However, that advice is probably right oftener than it is wrong, but it is always wrong in an extended bear swing. In such a swing, the tendency is to become dull on the rallies and active on declines. In other words, don't chase your geniuses. What you want to do is watch for the counter trend to happen, for these signs for the reversal. Have a list. Watch like a hawk. When you see the signs, you hop in and you start being active more on the downtrends, not in these impulsive low volume rallies, because we are still in a bear market, whether you want to believe it or not. So at around lunchtime, I'm watching the market and I see more names being added to the list, such as Apple, for example, rallying impulsively higher and shooting out signals that it is tapping out, it is running out of gas. I also say Nvidia update. They're closing the 190 calls, taking profits, while the volume in the 180 puts increasing. And I'm going to pull the trigger here and buy some Nvidia puts. Why? Now, it did not work out as I expected exactly because there was a catch. I'll let you know in a minute. But we look at the call options for Nvidia and we watch the volume, and this is for the expiration date of this Friday because this is the most immediate expiration. and it is the most impactful in creating gamma squeezes and pushing the market maker to make decisions one way or the other. Now, the rally started early on, and immediately we have a stampede on what? On the 190 calls. That becomes a wave. You don't want to stand against it. You want to watch it. You want to see what's going on. They get to 190, and then NVIDIA stalls. Now, if they roll up to a higher strike, in this case, the 200, and they did, but they did not do that early on, then NVIDIA rallies even higher, because that is where the force of gravity relies. When we contrast this with the volume for puts, anemic. We have volume, but it pales in comparison with the volume for calls. So obviously, the gravity was to the upside. But around lunchtime, they started buying the 180 puts aggressively, and that kind of stalled the rally in NVIDIA. Until, of course, the bulls started to roll up to the 200 calls, and then NVIDIA started moving higher again. Now, when it comes to Apple, it's a different story, because when we look at the call options, for example, the highest volume was the 145. They wanted to push Apple all the way to 145, but the name could not make it. It stalled at around 143, and then it pulled down. Why? Because immediately the 140 puts started to gain steam, and therefore Apple underperformed NVIDIA in a day like today, at least after lunchtime. So in a day like this is what I'm doing. I'm not chasing. I'm looking for opportunities to play the counter trend, because these charts are getting way overbought. And I know the terminology doesn't mean anything to a lot of you. You say, hey, Maverick, overbought, who cares? It's going to get overbought even more. But buddy, the technicals, the algos, they're blind. They get fed a certain amount of information and they react in a predictable manner, because we know how they're programmed. They're not looking at the circumstances around the rally, saying, oh yeah, it is overbought, but Powell is going to do this and that. They're looking at the technicals and the pure technicals only. And I shared this and I said, look at this. This is the chart of the Qs, the 2 hours chart. Every time the RSI got this extended, we got to pull back. So the bears, and I call them the pussy bears, who've been crying and bitching and moaning today, oh my God, the bear market is over. The bulls are going to... They gave you a gift, you moron. Did you use it? Did you take the gift or not? You want them to run as high as they can, ahead of earnings, ahead of the PCE, ahead of Powell, because that way, you know for sure, they're going to get flushed down in a big way. But if they stall, if they go up and down, if they consolidate, that's what you should be worried about as a bear. Because if the market consolidates right now, Powell doesn't see a problem. Says, okay, we're seeing some discipline here in the equities market, so I'm going to give the go ahead and do the 25, and then give the market the signal that we're going to pause very soon, because the market has been acting in a mature fashion. If the market rallies impulsively into the meeting, then Powell has to do the opposite. He has to go Jackson Hole on your ass and scare everybody that, hey, don't get too comfortable here. I'm going to crush your heads. And of course, another piece of evidence that this rally was pretty much led by the algos and mechanical reasons. I also said around 11:30 Pacific time, you want to buy some calls in the SQQs, because the viewer was saying, hey, should I buy SQQs for Friday just to play the counter trend? I said wait till 11:30. You know why? Because that's the last call for money managers. 11:30 to 12:30. That's when the human being interferes and start making decisions. And what do you know immediately? 11:30, the SQQs bounces higher and the Qs start to move down. The SPY starts to move down. The rally starts to fade a little bit. And now we're looking at the SQQs 30 minutes. Is it making an ABC pattern? Perhaps. And when we look at the actual Qs, you can see perhaps a formation of a reverse ABC pattern. And these are the beginning signs that this rally is going to stall really, really soon. And it's going to reverse really, really soon in an ugly fashion. Of course, you have to look at indicators such as the Dixie. Is the Dixie attempting to rebound, for example? That will be problematic for the equities market. Is the 10-year yield also attempting for a rebound? That will be a problem for the stock market. What if earnings come out disappointing because all of these names ran too high, too fast into the print? This is what I'm watching for. This is what I'm keeping in mind. Now, if you're saying, hey, Maverick, how do I get into your Discord? You got to be a member of the channel. Follow the link in the description and pitch in, you cheap. And I know we got problems in Discord, but I'm going to fix all of them. I hired 5 guys who are going to work on it in the weekend. I know they're not the same 5 guys who got caught banging the female cop in Tennessee. I know they need jobs, but we got standards here. Anyhow, folks, 2 more notes and then we move on. Note number 1 for the Top Gun Maverick members. I apologize. I did not get to making the credits today. I'm going to update them tomorrow. was busy cleaning up the damage from the storm. And note number 2, for folks who love the In Focus segment and the macro discussion, this is going to be disappointing for you because this show will be a lot of technicals. We're going to go over 35 charts, but rest assured, we're going to talk macro in tomorrow's video, and the one after that, and the one after that, and the one after that, and the one after that. Anyhow, we have earnings season, so let's talk about it, and here it is. Now we have a lot of names reporting earnings this week. We're going to look at the charts and look at the technical setup before these earnings come out. Now mind you, just a little warning for you. Earnings is a fundamental event, meaning these stocks are going to move one way or the other based on the fundamentals and based on these earnings. But the technicals are also important. The technicals will give us the setup. So whatever these earnings look like, good, bad, and the immediate reaction of the stock, knowing the technicals beforehand will enable you to conduct trades after earnings, not just before, after they come out, because usually we see pumps and dumps. We see gaps and craps. Why does this happen? An example, of course, is United Airlines popping higher, gap in the morning, and then it craps all the way down. Likewise, why do we see the phenomenon of stocks gapping down, getting crushed, getting creamed after earnings come out, only to catch a bid and then rally higher and close positive by the end of the day? Why does this happen? The answer is the technical setup. So with this understanding out of the way, on Tuesday, tomorrow, we have Johnson & Johnson in the morning, Verizon, 3M, GE, Lockheed Martin, Raytheon, and after the bell, we have Microsoft. So let's see how the technical setup looks like here for Johnson & Johnson. Here's a daily chart for J&J. Now, when we look at the chart, look at the RSI, the MACD indicators, they're all way oversold, beaten down ahead of the print, meaning the likelihood for a disappointment, even if the earnings report comes out bad, is less likely now. In other words, let's say J&J gaps down for whatever reason. We see it going down all the way to the next support of 166.82. If you see that's holding in the pre-market, then you're going to buy shares of J&J right after the open because in all likelihood, it's going to be bought, it's going to catch a bid and move higher. When it comes to Verizon, let's take a look at that one, VZ. I own the stock, I bought it recently, and when we look at the daily chart, it is in a bullish trend for now. Higher lows and higher highs. No problems here, with the exception of the fact that we have a negative divergence on the RSI, meaning we could see a disappointment here. We could see Verizon flushing down all the way back to the trend line in the worst case scenario. Yet when we look at the weekly chart, all in all, it faced resistance. It pulled down. It reversed. It got rejected. But it is maintaining higher lows. And even if it gaps down tomorrow, so long as the pattern of higher lows remain intact, you're gonna buy the dip in VZ because it's gonna push its way higher. Likewise, if it gaps all the way to the same resistance it pulled back from before, if we see a gap higher, for example, you might see the phenomenon of a gap and crap, a pullback right away from the same resistance that it pulled back from before. It is all about understanding support and resistance and looking at the momentum indicators. Charts that gap down because earnings are bad. They get really oversold, and they've been oversold beforehand, but they keep support. More likely than not, they're going to catch a bid and move higher. And of course, the opposite is also true because if you have a chart that is overbought, it rallied impulsively ahead of the print, and we see a gap higher because earnings were good. Who cares? More likely than not, you're going to see a gap and crap. When it reaches resistance and it doesn't pass that number, more likely than not, you're going to see a gap and crap. In the case of VZ, even if it goes down all the way to the trend line, so long as it maintains higher lows, the likelihood is the pullback could be a B leg in an ABC pattern that will take the chart higher to make a higher high. Next, we have 3M, and again, it's a giant industrial. It has been moving higher based on China reopening optimism, and maybe the dollar is down. That's good for 3M. But mind you, they've been having a hard time for a long time now. It's not just the dollar, it's not just China. The demand is low. The cost is too high because of inflation for them. The masking and gloves and all of that, that's over now. So the fundamentals not that good. What about the technicals here? When we look at 3M, a weekly chart, we have a sloping line of resistance. And the question here is, will 3M react to this sloping line of resistance as it did before and break above it? The answer is, in this case, in the weekly chart at least, I don't see it because you look at the momentum indicators, they're getting weaker. In other words, if 3M pops higher for whatever reason, you see it hitting and bumping against the sloping line of resistance, more likely than not, we're going to see a gap and crap in 3M. Next, we have GE, which happens to be one of the top performers year to date, out of all names, of course. The trashiest name is leading the pack. Now, as of late, the chart became really overbought on the daily, and it pulled down. And we see the negative divergence in the RSI right now. Now, we have a gap in this pullback, which happens to be 79.27. Today, the chart managed to close this gap. That is bullish, not bearish. The problem is, it hasn't closed above the top of the reversal candle. So for all we know, this could be an A, B, C pattern to the downside. Furthermore, we will look at the weekly chart for GE. What is this candlestick pattern? We have a red candle sandwiched between two green candles, at least so far this week. It is actually a bearish stick sandwich pattern, and it says it is composed of 3 candles, with the first one a big bullish candle, the second one a bearish candle with a smaller body, and the third one a big bullish candle that closes below the highs of the first 2 candles. This is exactly what happened today. So this is a bearish signal for GE. In other words, more likely than not, GE will pull down after earnings. And even if it gaps higher, for whatever reason, earnings are good, the dollar is down, yada, yada, yada. More likely than not, we will see a gap and crap in GE. It's going to pull down. The gravity in this name becomes downward in this case. Then what about Lockheed Martin, a name that I own? And we look at the chart here, the daily chart. There is a gap above at around 461.74. That would be a gain of around 4% or so. Now, the chart is really oversold in the daily, meaning the risk versus reward says if the report is decent, it doesn't need to be really impressive, just decent. That could produce a short covering rally in LMT and push it higher all the way to close the gap above. Now, when we contrast this with Raytheon, another defense contractors, but Raytheon it also has exposure to the industrials in China. It is a different name than LMT, which is a pure defense contractor. When we look at Raytheon, we have the top of a reversal candle at around 98.66. In other words, let's say earnings come out and Raytheon rallies higher all the way to 98.66. The likelihood is, if we have a gap all the way there, we will see the crap right after the open. It's not going to pass 98.66. If it wants to do it, it has to do it in the pre-market right away. But if it pops higher in the pre-market, but not north of 98.66, the likelihood is it's going to flush down from that point. When we look at the weekly chart all in all, the momentum is negative for now. We look at the RSI, we look at the MACD. We have a consolidation range that the chart will have to revisit sooner than later. So again, in the battle between LMT versus Raytheon, I'd go with LMT, not so much with Raytheon. And then after the bell, we have Microsoft. What do we see here? An MSFT. On the weekly chart, we have a pattern of lower highs and lower lows until recently when the chart made a higher low. And the expectations for now are that MSFT will move higher and make a higher high. This is the assumption. Is it going to happen right away? We know that the dollar is down in the quarter. This is good for Microsoft. But will that offset the weakness in Azure, for example? All of this talk is fundamental. It has nothing to do with the technicals. So let's say Microsoft gaps higher right away and it stalls at around 250. It doesn't pass 250. More likely than not, if it opens that way, we will see the gap and crap phenomenon. It gets to 250 and then it pulls back because it couldn't pass above this number in the aftermarket, pre-market, couldn't make it. Wednesday, we have CSX. Let's take a look at that one. This is the weekly chart. We have a downward sloping trend that was broken, but doesn't change anything at all. Of course, we know the fundamentals. Fertilizer prices are down. Auto parts, auto imports are down. Energy transportation down. So the fundamentals maybe not that good, but the technicals are neutral for now. Slightly positive. On one hand, we could see this as a reverse head and shoulder formation. Another way we can look at it is a cup and handle formation. Are you going to bet on it? Usually after earnings, CSX doesn't move in a significant way, one way or the other. So for this one, maybe you want to leave it alone and play it after earnings instead. If it gets above the Fibonacci level of resistance, which happens to be at around 33, then that would be a buy signal. If it fails, if we have a pullback, it cracks the Fibonacci support at around 30, that would be a shorting signal all the way down to at least 27. Next, Boeing, what do we see here in the weekly chart since the October bottom, if you may? A massive rally in Boeing. But it is now overbought, quote unquote, in the RSI and the MACD, meaning the risk versus reward says in the event of a disappointment, more likely than not, Boeing will move down. And even if it beats if it is not an impressive beat that blows out your mind, more likely than not, we will see Boeing pulling back. And the message here is, if you own Boeing, if you've been playing this rally, maybe it is a good idea to sell some upside calls, some covered calls right before earnings. Next, we have AT&T, and as we discussed in Verizon, it has been underperforming for a while, but since the October bottom, if you may, it has been rallying significantly higher. For now, it is keeping a trend line, but we have negative divergence on the RSI, meaning the setup for now suggests that AT&T moves down after earnings. But of course, it's going to move accordingly to Verizon's earnings. If Verizon moves down, the likelihood is AT&T will also move down. And of course, the opposite is true. Meaning, the opportunity here in trading AT&T would be if Verizon crushes earnings and we see a big pop higher, a gap higher, impulsively, and AT&T follows and rallies impulsively higher too. The risk versus reward says you gotta fade the rip in AT&T because more likely than not, it's gonna pull back right after reporting its own earnings. Now, with that being said, in the long run, do you wanna be in AT&T? The answer is perhaps. You know why? We'll look at the monthly chart. What do we see here? We see a reversal from a monthly perspective, the most important chart. We have a consolidation pattern in a bull flag. We have a negative divergence in the RSI. All indicators saying in the long run, you want to be in AT&T. In the short run, the risk is to the downside. Next, what about US Bank? What do we see here? It's the regional bank. I used to own the name, not anymore. But if you want to chase banks, you want to be in regional banks, not the big banks, because these kind of banks benefit more from the rise in interest rates. For now, looking at USB, a daily chart, we have negative divergence in the RSI, and we have resistance, the top of a reversal candle, a topping candle at 48. In other words, if the stock rallies all the way to 48 ahead of the print, and it finds hard time to pass above 48, more likely than not, the risk becomes to the downside. In other words, after earnings, USB goes down. Now, make no mistake, in the weekly chart, it is actually bullish. Look at the setup here. We have a trend, we have higher lows, we have a positive divergence in the RSI, we have consolidation in a bull flag pattern, but maybe we should see a pullback on the daily. So short term, not good, long term, looking a lot better. Then we have ServiceNow. What do we see here? This is a daily chart. The name rallied significantly higher ahead of the print. It is becoming overbought. The risk versus reward says if ServiceNow doesn't impress big time in reporting earnings, it's going to pull back dramatically. Then we have Lam Research, the ticker LRCX, a weekly chart. What do we see here? We have a reverse head and shoulder formation. We have the chart, at least for now, passing above the sloping line of resistance. In other words, it is turning bullish. So whatever happens in the daily chart, let's say that Lam pulls back big time after earnings because it rallied too high too fast into the print. The opportunity becomes in buying the dip. Forget about AMD and Nvidia. These names are chip designers. For now, they're going to have a hard time in the fundamentals. Forget about the technicals and the mechanics in the fundamentals. When we have the country spending whatever $1 billion to build all of these chips to manufacture for the companies that are making billions of dollars of profits, so the taxpayer, of course, is flipping the bill. But regardless, I'd rather be in the equipment makers, not the chip designers. In this case, AMAT, Applied Materials, and of course, Lam Research. So if it pulls down after earnings, keep your eye on the chart. If it rebounds again from the sloping line of resistance, now support, you're going to go in, pull the trigger, and buy the name. Then we have the big one here, Tesla, the souffle. What do we see here? It is rallying impulsively higher all the way into the print. Not all the way to my number of 150, but when I saw the rally today, and I'm long Tesla for now via calls, I did sell the 150 calls today, covered calls. And the reason is the premiums is just an offer that I cannot refuse. The premiums, when I sold them today, covered for all of my entry cost and then some. So now I'm getting paid to hold these calls into earnings for Tesla. And I have the 130, by the way. But if you're not in Tesla right now, the risk versus reward after a massive rally like this into the print, if the name disappoints, we're going to see a pullback. Now assume from now all the way till the report, Tesla cools down on its own. It pulls back, it consolidates, it behaves. Then more likely than not, Tesla is going to pop higher after the print. The reason is we look at the weekly chart. What do we see here? We see a chart that is bottoming for now. Look at the RSI, look at the MACD indicators. They're showing a change in momentum, at least for now. Whether that momentum lasts or not, that's a different story. But we have resistance at 155.5. If tomorrow the chart pulls back, it consolidates, and it behaves itself, we could see a pop after earnings that takes us all the way to 155.5, and that will be a point where you should take your profits and move on. And the reason is the risk becomes for a reverse ABC pattern. And lastly, on Wednesday, we have IBM. Let's take a look at that one. This is a weekly chart. What do we see here? For one thing, the RSI is in negative divergence. The MACD is crossing, producing negative momentum. So the setup is not that good. Now we'll look at the pattern so far. Isn't this a bear flag consolidation pattern? IBM, a value name, an outperformer last year, underperformer so far for the year, and this underperformance could be amplified after the print because the setup, the technical setup at least, doesn't look good for IBM. On Thursday, we have Southwest Airlines, the ticker LUV. Let's take a look at that one. Here it is. We have a reversal candle in the daily. We have negative divergence on the RSI. We have a weakening MACD indicator. We have an attempt for now to recapture the reverse candle, the top of the reversal candle, but the chart could not make it, at least today. And is what we're seeing right now a pattern of a reverse ABC? If that is the case, then the risk versus reward becomes that LUV will pull back after earnings, perhaps big time. And then we have another airliners in American Airlines. Now, when we look at the weekly chart, we have a descending, sloping line of resistance. That should be target number 1. And indeed, recently, it held as resistance last week. So far, American Airlines has stalled. If it pops above this line, then we have the line of support. That would be a big time rally. So we're not going to talk about it right now. We have to zoom in to the daily chart and see what's going on. The name rallied impulsively higher ahead of the print, and after UAL's earnings, it pulled down big time. And now we have a gap open below at 15.34. More likely than not, American Airlines will indeed produce a decent report for the fourth quarter, but even with that, the technical setup suggests that we will see a pullback and a closure of the gap at 15.34. Then we have Rockwell Automotion, the ticker ROK. Here's a weekly chart for you. What do we see here? We have a trend line holding for now. It diverged significantly higher. It topped, forming a bear flag, a head and shoulder formation. Doesn't matter how you look at it. The message is clear. The bull run is over, and it pulls down all the way back to the trend line again. Then it catches support, and it moves higher, and now it is fighting the top of a reversal candle over and over and over again. Recently, it made it above that line. Now this line becomes support, and it has been retested before many times. Now here's what's going to happen. ROK is in a consolidation zone, meaning it is running out of gas. We have to look at the support line as an indicator. If the chart, after earnings, drops below the support line, that would be a shorting signal. If the chart drops all the way to the support line exactly and then rebounds higher, more likely than not, we're going to see a gap down in the pre-market, but the dip will be bought in ROK. Now, when we look at the daily chart for the name, what do we see? Again, a similar story. We have a topping formation, a reversal, a negative divergence on the RSI, but most recently, the chart did a retracement. The problem is it running out of gas before it goes all the way to the top? And if it does, it is forming a reverse ABC pattern. In other words, the risk is to the downside in ROK. What about Dow Chemicals? What do we see here? This is a weekly chart. We have a reverse head and shoulder formation. We have an important top of a breakdown candle at 60.5. In other words, if the chart rallies all the way into the print and it stalls at around 60.5, more likely than not, it's going to pull down after the report comes out. You want to see it consolidating right now, losing perhaps a little bit of momentum, because that makes the likelihood and the risk to the upside that we will see an impressive print by Dow. It's going to take it to crack above 60.5 in the pre-market. But if it gets there before the print, then the risk shifts to the downside. What about ADM, Archer Daniels? What do we see here? This is a daily chart, and you can notice right away that the chart stopped at a double top, 99. Could not make it above that, forming a bear flag pattern that played down all the way to closing the gap at 83.22. Now the chart is forming a double bottom formation, and it is holding support at 83.22. In other words, the risk becomes to the upside. If the print comes out decent, then we will see ADM moving higher. Now, what about Valero, a name that I own in my portfolio, VLO? What do we see here in the weekly chart? Finally, the cup and handle played out, and it got us above the sloping line of resistance, but now the chart is facing the same high it faced back in 2022. In other words, the daily chart is becoming really overbought, which means the risk becomes to the downside, and therefore I did buy some put options in VLO as a hedge. Next, we have Blackstone, the ticker BX. What do we see here? This is a weekly chart. We're using a line chart. We have a sloping line of resistance that held over and over and over and over again. Sure, we have a false breakout, but the risk versus reward says for now, this name rallied significantly higher year to date. So if the print is not good, the risk versus reward says BX is going to pull back, and this sloping line of resistance is going to hold one more time. Now, when we zoom in to the daily chart of BX, what do we see? We have resistance at around 88.15. Now the chart is having a hard time passing above this number. So it needs a piece of fundamental news to do the job. If the earnings report comes out better than expected, BX will pop above 88.15. But let's say BX moves ahead of the print and it passes 88.15. Now the risk becomes to the downside. If the report is not that impressive, we're going to see a flush down. The chart loses 88.15 once again. Then we have Visa, the ticker V. What do we see here? This name doesn't move one way or the other in an impulsive fashion after earnings. It consolidates. But for now, what do we see in the technical setup from a weekly chart perspective? We have what it appears to be a reverse head and shoulder formation. Now we know from the fundamentals, the recent news, that the consumer is not doing pretty good, and perhaps this is bad news for Visa. But remember, they made a lot of money while the consumer was swiping those credit cards up and down, up and down, up and down. And the volume is large. And the fourth quarter is going to include December, November, and October. So we could see the name actually popping higher all the way to 233.5. And if it does after earnings in an impulsive fashion, it's going to stall there. And that will be an opportunity to bet the other way for a pullback, aka gap and crap. Last but not least, on Thursday, we have Intel, INTC. What do we see? I like the setup here. The name is bruised, overbeaten, absolutely annihilated. But recently in the weekly chart, we see a pattern of a double bottom. We see the momentum indicators, the RSI in positive divergence, the MACD in positive momentum territory. We see a consolidation pattern of a bull flag. All indicators are saying INTC should be popping higher after earnings. And then on Friday, we have AXP, American Express. Let's take a look at that one. This is a weekly chart. All in all, we have negative divergence, weak pattern. We know that the rich consumer who uses AXP, they're more disciplined than middle class and poor consumers. When they hear in the news that we have a recession, portfolios are down in the stock market, real estate valuations are down, they start pulling back on spending. So that's the fundamentals. When it comes to the technicals, what do we see here? Isn't this a bear flag consolidation pattern? In other words, I'm eyeing 138. This is a really important number. If the chart rallies significantly higher ahead of the print, more likely than not, it's going to pull back, and then I'm going to be eyeing 138. A break below this number will trigger a shorting signal. And last but not least, what about Chevron CVX? What do we see here? We talked about it not so long ago. A weekly chart, we have a cup and handle formation. We have a consolidation pattern, which is bullish. More likely than not, Chevron is going to break to the upside, but there's another way we can look at it in the micro perspective, which is, isn't this a bear flag consolidation pattern? And didn't the chart stop at 189.68? In other words, if the chart rallies ahead of the print to 189.68, the risk versus reward becomes for a pullback after earnings. But in the long run, the chart is bullish, so the dips will be bought. With that out of the way, let's do the stock market coverage for you. And we begin with the closing of the indices today. And here we go. The Dow Industrial Average in the green by 254.07 points, or a gain of 0.76%. The Nasdaq leading the pack with gains of 223.98 points, or a gain of 2.01%. The S&P also positive by 47.20 points, or a gain of 1.19%. When we look at the sectors, all in the green, led by technology, cyclicals, and services, risk-on rally. The laggards, utilities, energy, healthcare, the defensives lagging behind. Energy is the outlier, but perhaps energy is sniffing a rebound in the dollar that technology is failing to smell. We will look at the advance to decline ratios. NYSE 72% advancing versus 26% declining. The Nasdaq 63% advancing versus 34% declining. Now we look at the Nasdaq, the breadth was positive, but not that impressive. Yet the Nasdaq was up by more than 2% for the day. In other words, it is showing underlying weakness here. It is showing that the rally today was led by large names such as Tesla, Apple, and Nvidia. But all in all, there is underlying weakness in the Nasdaq, and that could be a leading indicator for an upcoming pullback. On to commodities, and today I'm watching energy and metals. And the reason is the dollar is maybe attempting for a rebound here. Whether that's going to happen or not right away, we'll see. It needs a catalyst. It needs a piece of news here. And we know that the market right now is addicted to anything. Bad news is good news. Good news is good news. Bad news, such as, let's say, the PMIs tomorrow, if they come out abysmal, the market would say, yeah, look at this. We have recession, meaning the Fed has to pivot. And that's positive. If the PMIs come out positive and they rebound higher, the market is going to say, oh, look at this, the soft landing. The market wants its cake and eat it too. The market now is in the mood of everything is good. Higher we go, we don't care. Until they slam their heads into an obstacle. And we have a lot of them coming. And therefore the dollar is jittery. And that impacted commodities accordingly. Today, initially, crude oil was higher for both the WTI and Brent, but both closed pretty much flattish for the day. All eyes were on natural gas because it appears that the party boy is back, baby, up by almost 9% for the day. And of course, this comes out in the heels of the news that we got today that the Freeport LNG facility is done. It is completed. It's going to be back on track in no time. And of course, this is forcing a lot of short covering, and therefore, maybe we will see a rotation out of oil into natural gas. It's not going to impact oil negatively by a lot because maybe we have another rotation in hand here, out of metals into energy, taking some profits from metals, gold, silver, platinum, copper, all rallied significantly year to date. But if the dollar is going to rebound, the more sensitive commodity to the move in the dollar would be metals, not energy. Meaning if the dollar pops higher in a rebound, metals will go down big time right away. But energy might continue to hold here. It might prove to be resilient. And this is what I'm watching for now. On to the options market, the big casino. What do we see here? Coming up in number one, per usual, the hottest table is Tesla, the souffle, with around 2 million contracts traded today. Look at this, around 56% of those were calls. Apple at number two with around 1.4 million contracts traded today. Once again, calls outweighing puts by 55%. Nvidia, not Amazon. Nvidia at number three with 800,000 contracts traded today. About 51.5% of those were calls. So now you know why we rallied significantly today. The human being was not really buying these equities. It was the computers. It was based on the options market activities, gamma squeezes. That's all there is. We have seen this movie multiple times before. We get one of these pivot optimisms. We see one of these low volume rallies happening based on options volume, and then the hawk comes out and he crushes everybody's heads. When we look at the unusual activities that took place in the options market today, we have a few here. We start with the ticker TXN. This is for Texas Instruments. Now, chips have been hot as of late, and we have Johnny come lately here chasing the rally, and they bought the 190 calls for TXN with the expiration date of March 17th. The expectations are for TXN to move higher by more than 6.5% by the expiration date. They paid around $3.30 a piece to enter this trade. All in all, spending around $500,000. And then what about the ticker TSLA? I sold upside calls, covered calls, fading the rip, and somebody now is fading the rip by buying puts. And the bet here is that Tesla will pull back by the expiration date of this Friday by more than 5%. They paid around $3.50 a piece to enter this trade, all in all, spending around $5 million. And then what about the TLT? Somebody sees more upside coming here, in the immediate run at least. They bought the 111 calls for the expiration date February 24th. Now look, my hunch is somebody's selling upside calls here, but we have to look into it from the buyer's perspective. And the expectations are that the TLT will move higher by more than 5% by the expiration date, and they paid around 65 cents a piece to enter this trade, all in all, spending around $1 million. What about the IWM, the Russell 2000? Somebody's fading the rip here, buying the 170 puts, for the expiration date March 3rd, with expectations that the IWM could move down and lose more than 9.5% of its value by then. They paid around 85 cents a piece to enter this trade, all in all, spending around $1 million. And last but not least, what about the ticker RIO for Rio Grande, I believe? It's a British miner, and somebody sees more upside coming for the name. They bought the 85 calls for the expiration date March 17th, with expectations that the name could move higher and score gains north of 8% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $1 million. On to the heat map. What do we see here? Risk on again. Chips moving higher, technology moving higher, cyclicals moving higher, industrials moving higher. What's lagging? The defensive names, the recession types, in big pharma, in utilities, in defensives. This is a risk-on rally. Do you chase it? You know my stance. Absolutely not. When we look at the heat map for the ETFs, what do we see once again? It is a risk-on, but we're seeing some counter trends taking place here. For example, while growth continues to outperform value, unlike other days, value's actually in the green today. We're also seeing a rally in natural gas, the laggard for the year. UNG, BOIL, significantly higher. We're seeing gold cooling off, GDX, flattish for the day. The only pattern holding for now is the outperformance of chips. Now, if the technicals don't take chips down, the fundamentals will. So I see a lot of risk ahead here, specifically out of earnings in these chips names that outperformed year to date. Now, when it comes to international markets, flattish, but be it in the green, and I believe that the outperformance in these equities will start to move down. Maybe not in the Chinese ones, but at least in European equities, the VJK, for example, I believe this thing is topping for now. Let's move on to charts. We've been talking about charts all day, but here's the SPY, the 30 minutes chart for the S&P. What do we see here? Now, the disciplined way would have stopped the chart at 398. But here's the problem. Last night we talked about a bullish scenario and a more bearish scenario. In the bullish scenario, the chart should pull back, seek some support at 393, and then move higher and crack above 398. And I said in the bearish scenario, we will see the chart moving all the way to 398 and then pulling back from there. Well, you know what? They gave the bears even a bigger gift. They got above 398. They got the charts really, really overbought now. They made the risk to the downside. They made it so easy for you. In other words, isn't what we're seeing right now a beginning of an ABC pattern to the downside? If that is the case, SPY is going to lose 398. Now, when we look at the daily chart for the continuous contract for the S&P, what do we see? We see it running into resistance again, 4,037, and it couldn't close above this number. Now, does that mean it's over? It's done? It's not going to make it above 4,037? The answer is not quite. The RSI is firming up, but it did not make a higher high. The MACD indicator is firming up. All of these are indicators that we still have the energy needed for the SPY to continue to move higher. The problem becomes the higher it goes, the riskier it becomes because it ignores earnings. It ignores the macro data that we're about to get, specifically the PCE inflation. It ignores the risk of the FOMC meeting. And therefore, if you happen to be a legitimate bull, you should be hoping for the chart to pull back and consolidate all the way till the FOMC, or at least until earnings are out of the way. Because if this continues higher, what the bears want to see is an impulsive rally. They go north of 4,000. They become really comfortable. The charts become overbought across the board. Then we know that Jerome Powell will have no choice but to come out and crush the rally. And it becomes so easy for the bears. So keep that in mind. The higher the chart goes, the riskier it becomes. The bigger the flush down. We'll look at the Qs, 30 minutes chart. Once again, the disciplined way would have stopped the chart at 284.26. It should have consolidated there. It should have gathered energy. It should have asked for buyers. Actual buyers. Not the traders in the options market. Not the algos. Not the gamma squeezes. But instead, it popped significantly higher above 284.26 all the way to the next resistance at 290. Now the chart is becoming severely overbought. Now the chart is at the risk of a big flush down. And isn't what we're seeing right now, at least the way it is shaping for now, a reverse ABC pattern? Will the chart be able, if it opens higher in the morning, will it be able to crack above 290 with fake support, not legitimate support? The answer is sooner or later, the facade is exposed. And what lies beneath is the rally was under low volume, no legitimate buyers, all mechanical reasons, and hence at risk at a big pullback. What about the futures for the Nasdaq, a daily chart? What do we see here? Most importantly, above 11,689 once again. That's good news for the bulls. The RSI, the momentum indicators are firming up. The problem is the rally came on the heels of very low volume. Now it is facing a resistance, a soft resistance at the top of a breakdown candle, but the actual resistance above is 12,207. We'll look at the IWM 30 minutes chart. What do we see here? It made a U-turn. It got all the way to 188. Forget about the SPY, forget about the Qs. If you want to look at the IWM as a leading indicator, notice that the IWM, which used to be the outperformer in the last few weeks, it did not make a higher high. It did not recapture 188 as support. This is the early warning signal. The SPY for the Qs for the Dow, that watch out, nothing happened today. All of these crossings that you guys did above important resistance lines, SPY, Qs, Dow, all of what you did is based on mechanical reasons alone, and mechanical reasons are not sustainable. We have rollouts, we have closings and taking profits, we have expiration, and therefore this rally is shaky. We see perhaps with the negative divergence in the RSI, maybe the IWM is also forming a reverse ABC pattern. Dixie, what do we see here in the daily chart? Is it planning for a rebound to come? The answer is it is possible because it stalled. It's not moving down anymore. It is holding ground for now. It is consolidating. It is asking for buyers. It is looking for catalysts to spark a rally higher. Whatever reason might come out for the dollar to move higher, it is a possibility for now. And therefore, gold is consolidating. It's not popping higher again. Gold is becoming overbought. Gold is at the risk of pulling back. The Dixie is at the risk of a rebound. If that happens, would that be good news for oil, for example? Let's say oil pops higher in another big upside day tomorrow. We see it bumping against 90, for example. At that point, it's going to become overbought too. You put two and two together, the dollar is looking for a rebound. Whether that happens tomorrow, whether that happens on Wednesday, whether that happens by the end of the week, the dollar is looking for a rebound. And a rebound in the dollar is not just bad for commodities. It's also going to produce a pullback in the equities market too, on top of that. Look at the 10-year yield. What do we see here? Look at the RSI, the MACD. They're all improving. The chart is now above 3.5. As if the 10-year is saying, wait a minute here, I want to go higher. And if the 10-year goes higher along with the Dixie, what is the message here? The Fed will surprise, perhaps not by the number. We know it's going to be 25 basis points, but maybe by how many times we're going to see 25 basis points increases. Perhaps the higher for longer, meaning the pause, is not going to happen as soon as the market is expecting. And by the way, the market is actually pricing in interest rate cuts. The market is not even pricing in more 25 basis points increases. The market is not even pricing in raise, pause, and hold. The market is actually pricing in cuts. The 10-year says not so fast. Maybe we'll see a pop higher tomorrow, along with the dollar. And this will cause reality to start to sink in a little more. TLT, what's going on here? We just talked about perhaps an upcoming pop in the 10-year yield, so you're not going to chase the TLT here. You want it to go down and reach support, perhaps 103.5. We see the RSI in negative divergence. We see the MACD rolling over, about to cross to produce bearish momentum. What about the VIX 4-hour chart? What do we see here? Negative day for the VIX, but it went back and forth in a battle. It doesn't want to give up 20 easily. It is keeping for now the pattern of higher lows, but it is losing some momentum, meaning that tomorrow is going to be a pivotal day for the VIX. Either it gets 20 as support, or down it goes all the way back to the 18s. This will initiate another leg higher in the SPY. But if it does recapture 20, let's say in the pre-market, that will be a leading indicator the SPY is going to pull back. Apple, 30 minutes, what do we see here? Impulsive rally. It cracked above all of these resistance lines, and then by the end of the day, it lost some momentum because it got really overbought. Now, could it be that Apple is just pulling back to form an ABC pattern that will take it all the way to 145? Everybody's buying the 145 calls. That could indeed be the case. But the risk versus reward says, let it run. Let it go to 145. Who cares? The risk versus reward becomes the higher it goes ahead of the print, the bigger the pullback, the bigger the reversal. So is the opportunity once again in chasing the rally or waiting the sidelines, looking around, sniffing for the counter trend and play it the other way? It could be a painful process. You're not going to get it right the first time. You might lose some money. So you might want to wait for confirmations before you pull the trigger. But if you chase these rallies higher, you're paying an arm and a leg in premiums. And for all you know, tomorrow could be the day when they pull the rug. For whatever reason, the higher they go, the riskier it becomes. Now, we talked about Tesla, so we're not going to talk about it again. We're going to do Bitcoin, a daily chart for tulips. Big time pop, but it is stalling at the resistance of 23,189. Now, Bitcoin has been a reliable indicator for the equities market. The moment we saw the pop higher above 20,593.35, equities markets followed the footsteps of Bitcoin. But now Bitcoin is stalling. Now Bitcoin is becoming really overbought. It is showing what's going on in the equities market ahead of time. So if you see Bitcoin starting to reverse here and failing to cross above 23,189, that would be a leading indicator that a pullback coming in the equities market. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the PMIs, the manufacturing services PMIs, also known as the flash PMI. We talked about earnings before, so we're not going to talk about it now. Anyhow, folks, once again, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow, hopefully at an earlier time. Take care.
It's a trap! It's a trap! Also, who's cat?